So we're in that very positive feedback loop, all-time highs beget all-time highs, and that's just going to keep being the case here for a while until something does. And we're going to have a correction this year. So expect a 5 to a 10% correction. I would suspect probably sometime this summer.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart, welcoming you back here at the end of the week for another weekly market recap featuring my good and hospitable friend, Lance Roberts. How you doing, Lance?
I'm doing great. It was great seeing you last Saturday. A lot of fun. Enjoyed you being here for our conference. I thought it went well. And so, yeah, it was great to hang out with you for a bit. Have by lunch.
It was a lot of fun. Really enjoyed, obviously, seeing you and the team, but certainly really enjoyed meeting all the people that showed up. These live events are so valuable to me. One, just because everybody is so kind and gracious, but you know, I try to run this channel based upon what people care most about, and I try to listen a lot to every email and every comment and whatnot, but nothing suffices or nothing's better than being there in person with real people and having them tell you, you know, what they value, where they'd like to see things improved and whatnot. So great experience all around. Really enjoyed the keynote speaker there, Greg. Maybe we'll talk a little bit about that later on here, Lance. But again, you guys took very good care of me, hence hospitable as your introductory adjective this week. Lots to talk about. Lots of data has come out this week. And I guess before we get to just talking about what the markets have done, maybe we get to just start with your reaction to the FOMC update that we got this week and the guidance from Jerome Powell. I've talked about it with a few folks on this channel. I just did right before we recorded here a few hours ago, recorded a live event with Axel Merck for the premium Substack audience. So I'm fresh from Axel's download, but I'd like to see what you took away from this week's guidance.
Yeah, no, I mean, it was really pretty much in line with kind of what we expected anyway in our shop, because, you know, there's no need, while the market, and we've talked about this numerous times over the course of the last several conversations with you, and even talked about it last Saturday, is that, you know, when you take a look at the Federal Reserve, and, you know, we no longer operate on fundamentals in the market. It's all about what's the Fed going to do next. And the markets are pricing in 5 to 7 rate cuts this year. They were expecting a rate cut at the meeting on Wednesday, and we're like, there's no reason for the Fed to cut rates here. Everything's fine. The economy's fine. Employment's strong. Wage growth is doing well. That showed up in today's on Friday's employment report, which is going to push out a rate cut even further. The Fed's at 3 rate cuts this year, which is possible. The market is at 5 to 7, and so they've got to somehow try to bridge that gap in between. But, you know, the conversation from Jerome Powell, there was a few edits to the statement, and, you know, really nothing surprising. He's trying to kind of thread that dovish needle at this point. But, you know, just kind of reiterating the same thing is that, yeah, they're probably going to cut rates, and at some point they're going to have to start reducing their balance sheet, but that may be a little bit further off than markets expect. So on Wednesday, markets sold off on that news, and then not surprised, and we actually did a little bit of buying on Thursday morning, because the markets very quickly pivoted right back. It's like, okay, well, he didn't tell us he was going to cut now, but maybe he'll still cut in March. And then, you know, on Friday, the employment report kind of is going to push that potential rate cut out even further.
Well, we're going to talk about the jobs data. But Powell, you know, when he was asked, he basically said, I'm not planning on cutting in March. Like, I wouldn't expect us to cut in March. He actually said, it's not our base case. I don't actually see us cutting in March at this point in time. And what's so interesting is the markets, which have been pricing in all these rate cuts this year, they shrugged it off. Yeah, there was a sell-off on Wednesday, you know, as the news was coming out, but then, you know, they rebounded, and this morning we're talking here on Friday, markets are having a great day. Yeah. So we'll talk about earnings in just a second, but what is interesting is so it's February 2nd when we're recording this. It's Groundhog Day. It kind of feels like we're back in the old Groundhog Day, where it's like, look, you know, Powell's out there playing coy, telling the markets, I'm probably not going to cut exactly on the schedule you think I'm going to. Markets saying, well, we don't really care. We're gonna act as if we don't believe you. And all the activity is going on in the Mag 7 stocks, and they're all doing great, and everything else is kind of lagging. I mean, it feels like we've seen this script for a long time, and we've come right back to it.
Yeah, and look, this has been the case really since October of 22. It's hard to believe that it's been that long, but you go back to October of 2022. I'm not misspeaking. I don't mean October of 23. I mean October of 22.
Right, when we
Uh,
bottomed. Yeah.
we bottomed at that point, and ever since then, it has been a incessant rally based on the expectation that the Fed was done hiking rates and that they were going to cut rates, and it's back to monetary accommodation. And this is very fast. It's fascinating, but it's also just a part of human nature. Is that over the last 13 years, we've trained investors that at the first sign or first hint of trouble, the Fed's going to cut rates and increase liquidity to the markets. And so beginning in October of 22 and really all the way down, if you remember in October of 22, yeah, we were having a correction in the market, and there was the Russia, Ukraine, we're going to have World War III fear. And there was this fear, and interest rates are going to the moon fear, and inflation is 9% fear. And at every time the market would sell off, it would rally right back. And it was that FOMO that we had from investors. And I would get emails like, is this the bottom? I don't want to miss the bottom. I got to buy the bottom. And it's very differently to what you saw in a real bear market. Again, 2020 market, it was a correction. 2008 was a bear market. That was the last real bear market we've had. And that's an environment where you do not want to own stocks. So people, it's like, hey, stocks are cheap. You want to buy some? Hell no. Are you crazy? I don't want to own any stocks. Market's going to zero. That's a bear market. 2022, every time the market dipped, it was, I got to buy the bottom. I don't want to miss the bottom. I don't want to miss my opportunity to be in stocks when they go up and the Fed cuts rates. And so we've been rallying this market since October of 2022, all of these expectations of these coming Fed rate cuts and those type of things. You kind of have to, the obvious question is are rate cuts priced in? And we won't know until we get there. But
right. Or are they overly priced in? But
we're back to multiple expansion, and there is absolutely nothing wrong with this market right now. We're setting new highs on Friday. That little correction we had on Wednesday was very much needed. We talked about the markets being overbought, that you needed to have a bit of a correction, and it corrected right to the 20-day moving average, bounced off support, and now we're back up to all-time highs on Friday. So we're in that very positive feedback loop. All-time highs beget all-time highs, and that's just going to keep being the case here for a while until something does. And we're going to have a correction this year. So expect a 5 to a 10% correction. I would suspect probably sometime this summer. Markets tend to correct going into a presidential election because markets don't know who, they know what they have with Joe Biden. They're pretty confident of what they'll have if they get Donald Trump. But going into the election, you don't know which one you're coming out with. And so markets tend to sell off going into the election until there's a determination of who the next president is going to be, and then markets rally after that. Because once they know who the president is, then based on him or her, whoever it's going to be, and there's some theories that in May that Biden will be replaced by Michelle Obama. So by the time we get to November, whether it's him or her, coming out of that election, the markets quickly go, okay, I know what I'm going to get. I'm going to get, if Trump's elected, we're going to get tax cuts, we're going to get whatever. And, that's, I'm going to base my investments on that. If I have the incumbent or replacement, I know what I'm going to have with that. And so I'm going to place my bets accordingly. So that's why you generally get a correction during the summer. And with markets, very overbought right now still, we're deviated from 50-day moving averages. We're deviated from long-term moving averages. You're going to get a correction at some point. Now, what triggers that? Who knows? But a 5 to 10% correction this year is very likely.
All right. Got plenty to move on to in here. We now are really seeing how earnings season is shaping up. I want to get to our S&P chart and find out where we are on the, if we're still in overbought territory, and if so, how overbought. Real quickly, before we move off the Fed, one of the things that's getting a lot more attention than it normally does is the Treasury's quarterly guidance. Can you talk about that for a minute, about how markets are reacting to that, or at least how the bond market is reacting to that? Because the Treasury's been a pretty big provider of liquidity over the past year or so, and so all eyes are looking at what it's going to do going forward. What are you taking away from its latest report?
Well, the latest report is they're not going to issue as much debt as they thought. Now, remember, most of this is you hear these really big numbers off the cuff, like the Treasury is going to issue, 700 billion of debt or wherever the number is. But a lot of that's just replacing bills that are rolling off, right? So, what's your actual net issuance? That's and turned out the Treasury's not going to have to issue as much debt, but they're still issuing a ton of debt, but they're not going to have to issue as much, and so that was a little bit of a relief to the bond market. One of the big concerns has just been, too much debt,
Oversupply.
an oversupply of debt, and you just don't have enough buyers, so rates go up. And that's not true. But, in this environment, there's plenty of buyers still for debt. So there's not a lack of buyers by any stretch of the imagination. But that's a concern. So the issuance, the fact that they're going to issue less debt relieves some of that pressure. Now, the news on Friday with the employment data was a lot stronger than expected. That suggests the economy's firing on all cylinders. Wages were much stronger than expected, so that's potentially an inflationary pressure. Bonds had gotten we had a very big runs in bonds this week, so it wasn't surprising to see a little bit of a sell-off on Friday in the bond market. We actually changed some of the duration in our portfolio. We have a very big chunk of our bond portfolio. Let me rephrase that. We have a very big chunk of our bond portfolio in 1 to 3 year treasuries. So we shifted about a third of that into 7 to 10 year treasuries Friday morning at the open.
All right. Well, that's pretty material then. I mean, a third of what you had in.
Yeah, but out of 40% of our bond, so our portfolio is 60-40, right? 60% stocks, 40% bonds. We have, out of that 40, 15% of that was in 1 to 3 year treasuries. So we shifted a third of it, 5%. We're still, we still 25% of our bond portfolios in very short-term duration. So we got to shift. So we talked about needing to shift that duration longer. And as the Fed cuts rates at some point this year, doesn't matter when they do, but they will, then rates will drop down across the long end of the curve. And so we want to be there before that happens.
Okay. Yeah. But I mean, I'm just noting that this sounds like a decision you and your partner, Michael Leibowitz, there made to say, okay, we're starting to move, a not insignificant amount of our short duration stuff further out the curve.
Yeah.
Okay.
Well, and because also you're going to lose, the yield on the 1 to 3 year treasuries is good right now, but that's going to go away as the Fed cuts rates. So I don't want to be trapped in short duration. And plus you get no bang for your buck on a duration basis as rates come down, right? They don't appreciate that much. So you kind of get a double negative in really short duration bond, 1 to 3 year treasuries. They're fine for holding short-term cash, but on a longer term basis, you don't want to be there.
Right. And I guess if rates do come down, you get a double benefit on the things that are further out the duration curve. You get to keep that nice rate and you get the appreciation.
Correct.
Okay. So earnings season. So we had a lot of the Mag 7 stocks report this week, and it seemed for the majority, the market really liked what it saw.
Yeah. And interestingly enough, I mean, it is very segregated to just a handful of stocks. In fact, I just posted a chart on Twitter this morning. Here, let me share my screen. If you take a look at earnings, it is a very narrow window of what companies are actually growing earnings versus those that aren't. And so if you take a look at the forward 12-month EPS on NASDAQ stocks, and this is primarily, remember, even in the NASDAQ, it's primarily Apple, Google, Meta, et cetera. All the earnings growth is coming from those stocks, not the rest of the market. So if you take a look, UPS had a terrible report this week. If you take a look at most of your other stocks, particularly your small cap, mid cap companies, they're not growing earnings. They've actually got earnings contraction. So we're chasing a market that, yes, companies are first of all, companies are beating very much lowered estimates. And so it's great that companies are coming in. Google had a good report, a little bit light on revenue, but had a good report, but they barely beat estimates that were already dropped dramatically from last year. So again, we dropped estimates for the S&P 500 about $8 a share just in the last 2 months of the year, and companies are barely getting over that bar. So yeah, we're growing earnings, but it's certainly not at the robust level to justify companies trading at 30 and 40 times price to sales. You just don't have that type of revenue growth in the market, but that doesn't matter right now. It's all about the Fed.
I was going to say, so of course, then multiple expansion. Why not?
Yeah, well, that's what you're getting. And look, markets rise, and I had that chart in our presentation over the weekend showing, when you're in a secular bull market, that's a period, as we are in now, that started in 2009. That's a period of multiple expansion where we continue to pay more and more and more for every dollar's worth of earnings, because we think this cycle is just going to continue indefinitely. But it eventually won't. You're going to go through a period of multiple contraction. But the problem for most investors that have never seen a bear market, they don't know what that looks like. And so you go through a period of 10 to 15 years of a multiple contraction phase, and your rate of return on stocks is near zero, 0, 1, 2, 3%, all of a sudden it's no longer a fun place to be an investor in.
Yeah. I just want to note here too, for when we get to the jobs data, we're back in this market bifurcation, right? Where it's a very few stocks that are powering the indices higher, and we're seeing the vast majority of the stocks in the indices getting left behind, right? And you talked there about EPS for those smaller stocks starting to roll over. We talked about this a bit in Houston, but when you look at the jobs market, and if you're concerned about it, you got to be concerned about weakness in the small to mid-sized companies, because that's where the vast majority of jobs are in America, right? We look at the headlines, we look at all the big brand names that are laying off, and I actually have a list I'm going to run through in a little bit later. But those, on a relative basis, that's not the iceberg. That's more the tip of the iceberg. We got to worry more about the iceberg, which is the small and medium-sized companies.
Well, yeah, we talked about that. 50% of all your jobs come from small to mid-sized companies, and that's one of the big flaws with the BLS employment report. Is they survey large companies because they're easy to get a hold of, right? So they survey large companies and say, okay, what's your employment situation look like? Well, big companies like Apple and Google, they're hiring. But then they extrapolate that out to small and medium-sized businesses, that is not the case. But that's why you get these flawed numbers in the employment data, is because of that extrapolation when you survey a small pool of one type of employer, and they say, okay, well, if they're doing this, everybody must be doing it. Right. And that's really, you take a look at the NFIB report, which is the National Federation of Independent Business. That is a organization of small to mid-sized businesses, and their outlook is pretty dim. And there's been a lot of videos out on TikTok and other and Twitter and other social media places lately. I got into that side of social media somehow, but I'm now.
They're highly reliable media sources like TikTok. Yep, keep going.
Right. Well, no, I'm not saying that, but these are people though making videos going, hey, I don't understand what's going on. I hear about how great things are, and yet I've sent out 1,400 resumes, and I'm not even getting a call back. And it's not just one person. This is a lot of people that are noting, and particularly they're putting resumes out on LinkedIn, and they're getting no responses whatsoever, even though there's supposedly all of these job openings. So yeah, and to your point, credibility is a big issue. But again, there's just this kind of underbelly to the market, and I've said this a couple of times on our show, and I get a lot of emails from people going, yeah, I'm having exactly the same issue. I'm sending out all kinds of resumes, and I'm not even getting callbacks.
So let's put a pin in this, because I want to dig a little bit deeper into this when we get to the jobs part. Before we do, though, can you start pulling up your S&P chart? Because I just want to give folks a visualization of where we are right now on relative valuation side of things. Yeah. That being said, though, I do have some data here that's going to almost turn the jobs section into our rant for the week, but it's not, because I've got some other good rants. All right, so here we are. We're still in that uptrend that's way above the moving averages at this point. Yeah, it's looking like we're still in overbought territory, but I'll let you editorialize here.
Oh no, you've got it right. I mean, the top charters are kind of our primary buy signal, sell signal, et cetera. And again, we're doing very much similar to what we said this last Friday, is that we're this move in the market is very similar to what we saw in March, April, May, June, July of last year. The markets were at a very high level in terms of the MACD signal, and just kind of grinded sideways on that signal. The market just kind of ground higher on expectations that the world is fine and it's all about AI, and we're back into that whole game again. It's all about AI now, and every company that comes out and says, oh yeah, we're going to do AI next year, the stock just takes off. But we're into that cycle, and this cycle is going to end at some point, and that's why I'm saying that probably sometime this summer. Could be sooner, could be March, April, May, could be May, June, July. I don't know when it's going to occur, but sometime early this year, we're going to get another 5 to a 10% correction. That'll just be kind of that reset that we'll go through. The Fed's not going to hike rates or cut rates as much as we thought, or they're not going to taper QT as soon as we thought, or there'll be some issue, right? It'll be just something that happens that causes this market to cool its heels a little bit, and that'll be very healthy. We need to get some of this overbought condition worked off. This deviation that we currently have between the market and the 200-day moving average is about as egregious as it was back in July of last year. So this big gap between the market and the 200-day, that's got to resolve itself at some point as well. So again, moving averages act like gravity. So, kind of like we talked about stretching rubber band, is that when you stretch that rubber band, it's going to eventually pop back to gravity. And that 200-day is acting as that gravitational force. So it wants to pull those prices down towards that moving average at some point. And that's going to happen. Again, what causes it, who knows? But you'll have plenty of signal. The market will start to sell off or trigger a sell signal. We'll talk about reducing risk in portfolios. And that'll probably be in the next, couple of months or so.
All right. And I just want to take a minute here and underline your point there about reducing risk. So, we'll get comments that are like, oh, you guys, keep bringing up all these bearish points and you're missing the run in the markets and all that stuff. And I just want to really call out for people that we're not delivering a, hey, everybody get in the bunker message on this channel. Right. When the market is running, the market is running. It is what it is. And I think, you do a really good job week after week of reminding us, Lance, we got to deal with the markets we have, not the markets we wish we have or we think should exist, right? And that's not to say don't throw caution to the wind, far from it. And I think it's really important to keep caution at the very forefront of your mind. But you just want to be practical and to say, look, if the market momentum is grinding higher for whatever reason, whether you like it or not, if you're an investor and your job is to make money over time, you should be asking yourself, if the bulls are running, how can I participate in that in a way that makes me feel comfortable enough with my risk profile, right? I think a good financial advisor like you guys, Lance, what you're trying to figure out how to do is, okay, how do I participate in the markets we have and yet cognizant of some of these risks that we have out there? How do we do that in a way where if the market does turn suddenly, or if these fundamentals that have not mattered for so long suddenly start to matter again, how do we do that in a way where we're not vulnerable to losing a huge chunk in a drawdown, where we've got enough hedges or at least enough diversification or other things in place that our expected odds are still pretty good of riding what upside momentum remains, but limiting some of the downside impact.
Yeah, and that's why. So on SimpleVisor, we're just launched a second money flow analysis, which is what I'm showing you right now. And this uses weekly data versus daily data. And the reason this is important is, look, the biggest mistake that investors try to make is they try to avoid all losses, right? So, I don't want to lose any money, so I'm going to get out now, and then they wind up missing a big chunk of the advance. Just understand that when you invest money, be okay with losing some money. Now, I'm not saying lose a lot. Now, it's a big difference, right? But I'm okay with losing a little money because I will have hopefully made a bunch of money on the way up. And what this weekly indicator does, again, this is a beta version. We're going through a complete revamp of SimpleVisor right now. We've got the new format of this is really cool. I saw it yesterday, so I'm really excited about rolling it out. But this is one of the graphs that'll get updated. But this uses weekly data, and what it does is it smooths out kind of the market dynamics to a bit. But even you'll notice that last year, as an example, the market peaked in July. You didn't get a strong sell to reduce, really step out, reduce equity risk until August. And then you avoided all the drag from, in September and October. You missed a little bit of the bottom in November, and then triggered about mid-November, you triggered a strong buy, and you've been in ever since. And so, what this helps do is avoid, panic selling and getting out of the market, and then figuring out you got out too soon, the market's still running. And so now you've got to try to get back in and do that. And this analysis works with individual stocks, it works with markets, it doesn't matter, it's all the same. But the whole point of investing is trying to invest long term. And there's stocks in our portfolio that we've owned since the beginning, and we've trimmed them down, we've reduced them back during risk periods, we've added to them when the risk period is over, and we've just kind of take profits and reduce risk as needed, and then add that money back as things grow. And so there's stocks that we've owned that are up a lot over that period of time, because we just kind of manage that risk exposure, kind of as we go along. One thing we can talk about later is last week, we had a whole lot of people requesting an all equity model that would provide better yield. So last week we launched a dividend growth equity model, and it's kind of a unique model because it has a lot of the S&P beta to it, but has double the yield of the S&P. So we're beta testing that one right now, and hopefully we'll have that out to our clients in the next month or so. But there's just a lot of things that we can do to try to take advantage of the market that we have, but still manage risk as a function of that process along the way.
All right, a couple of things. One, I'm sure you just perked up some people's ears. So if the back testing goes well on that new model, when you do roll it out to clients, I'd love for you to just, on one of these weekly market recaps, tell us more about it for folks that are interested. Yeah. Secondly, when SimpleVisor, when the 2.0 version releases, same thing, maybe we'll let you give a couple minutes of a refresher here for folks on exactly what SimpleVisor is, because I'm not sure every viewer really gets it. And it's a nice service that people don't have to become a client of yours necessarily, in terms of having you manage their assets. They can just use the SimpleVisor tools and resources to manage their own money if they're more like a DIY type of person.
Right, and that's really what this whole platform is for the DIY investor. But a couple of things that are coming out is a complete new interface, but then also there's about 10 portfolios that are coming along with SimpleVisor that you can invest money in, and they're managed for you by the SimpleVisor platform. So there's a lot of really cool innovation that's coming over the course of the next 2-3 months as we get there. But the dividend equity model is actually live now on SimpleVisor, so I can show you some of that whenever you want.
Okay, I'm not going to do it this time just because we got so much to go through, but we'll leave people hungry to learn about it. Just to revisit the point I was making earlier. So I had conversations yesterday, both with Sven Henrik, as I mentioned, and with Axel Merk, and the theme of them was both sort of like, whether you like where the steamroller is going, or the direction the Mack truck is headed in, whichever analogy you want to use, whether you're happy about it, whether you're unhappy about it, it doesn't make sense to just stand in front of it on principle, out of spite, right? It's just going to roll you over, right? And the point is one of the challenges that bears have is the entire system, the entire power structure is trying to keep the party going. So if you're going to be on team contrarian on the bearish side, you really got to be right, and you really got to have your timing pretty good too. And I'm not saying, hey, don't be bearish if that's what your analysis tells you to do. I'm just being eyes wide open that every part of the system is trying to keep the bullish part of it going. And so you got to realize you're fighting everybody when you're taking that bearish position. And I'll give a little preview. So the day after this video, if folks are watching this on Saturday, tomorrow, Sunday's video is the one with Sven. And you're probably going to not like the general thesis if you're a market skeptic like I am in general. And he basically said, look, he said the bears had every opportunity to try to gain control of the markets over the past couple of years. I mean, you couldn't have asked for more, right? You had this global pandemic. They shut down the economy. You then had like the greatest rate hike, campaign in history, right? And he was like, but they still couldn't break the market momentum. And so he's kind of saying, look, I think for the foreseeable future, the bulls, like it or not, they're just proving that they are in control of this thing. And when we dug into kind of his outlook for the year, he's definitely got some concerns about valuation and thinks that there's some uncertainties in 2024 that yeah, it's probably going to be a bit of a bumpy ride this year from his perspective. But sort of like guys like Felix Zulauf, he's like, whatever happens this year that begins to get things out of the hand of the central planners, the response is going to be so egregiously big that the resulting spike in the markets is going to be gargantuan. So like, again, if you're sort of expecting this sort of bearish washout of the markets, probably not going to happen. I mean, you might get a little bit of time where markets start to soften, if something starts really wobbling in the economy. But the response from these guys, they've proven, is they're going to be early and they're going to be really big. And so again, it's just cautionary. Who knows what's going to happen? I'm not saying that Sven's got it exactly right, but I'm just saying more and more of these folks I talk to are saying, man, and he says, I don't like this prediction. He's like, I think we should have a recession. I think we should have a big market correction. I'm just not sure we're going to have one because bears pretty much had the table served for them and they couldn't take advantage of it.
No, it's very true. And actually, they did in a lot of ways. They did well. Back in 2022, there was a lot of stocks that were down 70, 80, 90%. Meta, as an example, that stock went from, almost $350 a share down to roughly $100 a share. Now it's back to $450. So, it just, there's a lot of companies got really beaten up during 2022. A lot of companies went out of business. And now you've got that kind of tailwind of market dynamics back in phase. And, the thing is, it's always interesting. There's a lot of reasons to be bearish. And look, we write a lot of bearish stuff. I've got an article out today talking about, should retirees put as much money as they're doing? They're piling into equities right now. The retirees are putting a lot of their money into equity risk right now. The whole construction of the article is, well, should you, particularly given, where we are valuation wise, et cetera. But the tailwinds are behind the market, and look, it's a lot more fun to make money in the market than it is when the markets are going down. So I'm not sure why you fight it. Just to enjoy the swim while you have it.
Yeah, and I think I think that's what I'm trying to underscore here, which is we tend to put ourselves either in the bullish camp or the bearish camp, right? And I guess what I'm saying, Lance, and this will be music to your ears, we really should aspire to be more like eagles, right? We really should be saying like, hey, look, there's some bearish elements and there's some bullish elements, and I'm going to try to basically position to take advantage of both of them, seeing the market as it is. And so, yeah, I guess that's kind of my advice to people, which is if you self-identify as a bear, maybe start thinking about self-identifying as an eagle.
Yeah.
Again, I'm going to change. I guess I got to change my Twitter handle to.
Well, you can use our logo if you want. You can put that on your handle.
All right. As long as your lawyer signs off, I'm not going to be
no worries.
Copyright infringement. Okay. So much to get to, including your article about whether retirement savers are maybe taking on too much risk in this market. But let's get to some of the other information that came out this week. So we've referenced the jobs numbers a little bit. Let me just lay the groundwork here. So folks, the payrolls number just came out, massive blowout, 353,000 jobs were added versus expectations of just 185,000. That was another massive sigma beat. I think this was a 4 sigma beat versus the analyst expectations. Now, of course, this is where it starts getting really frustrating. To your earlier mini rant there, Lance, like these incredibly rosy numbers don't seem to be jiving with sort of folks' real boots on the ground, views and observations. And as in the past, there are 2 ways in which the payroll, 2 surveys that the payroll analysts use to come up with their numbers here. One's the establishment survey, which is that 353 one. Then the other is the household survey, where they actually call up real houses and talk to people. Well, that one showed that jobs dropped by 31,000, right? So we're beginning to see, an even bigger gap between the methodologies that are used by the same organization to to calculate the payroll numbers. First-time jobs actually declined by 63,000. Part-time jobs surged by 96,000. So, we're definitely seeing kind of a diminishing of quality of the job base here. We've talked about this a lot. You did mention that the average hourly wage increased, Lance, but that's only because hours worked during the work week declined. It wasn't actually that nominal wages increased. It was just they're taking that same wage for the week and they've got a smaller denominator now.
That's correct. And it's a pretty big drop, by the way, too. It went from 34.4 to 34.1 hours. So pretty significant drop.
Yeah. And then last stat, and then I'll let you take it over here. So the unemployment rate remained unchanged at 3.7%. I did a wonderful interview with Lacey Hunt that folks, if you haven't watched it yet, you should definitely watch it after this one. But Lacey, these numbers don't jive with what Lacey says he's seeing from the data that he looks at. He cited a stat that 45 states that their unemployment offices are reporting increases in unemployment benefits now. So again, we're sort of, we've made this comment before. Like I sort of feel like I'm watching the news, and the meteorologist is telling me how sunny it is, but I'm looking out the window and I'm seeing the rain, right?
3 days, Adam. 3 days. That's all meteorologists are good for.
Yeah, but I mean, they should be pretty good in terms of what's happening right now, right? And it's just that kind of like, look, you and I talk about how much faith we can put in this government data, the data that's put out by the BLS. Is it as rosy as it seems? I'm not really sure it is, but it's ones like this where I'm like, come on, guys, this is almost in the like, don't pee on my leg and tell me it's raining kind of deal.
Yeah. So, I mean, no, you kind of hit it. It's interesting to watch what's going on. So this chart I've got up right now, this is the cumulative difference between the household survey and the official BLS report. And as of this last report, we're near 1 million job discrepancy on a cumulative basis over time. So it's a very interesting situation. And people have seen this chart before. There's this growing gap between the cumulative actual workers that are out there versus what the BLS says. And the number of workers are actually declining, even though BLS says we're just printing these amazing amount of jobs every month. But don't forget, this is an election year, by the way. So we still have revisions coming next year, which could be very interesting. This is the most important chart, though, that I keep going back to, which is full-time employees relative to the working age population. Now, this actually, the full-time employees relative to the working age population actually ticked up slightly in this past report. The only reason, though, that it ticked up slightly in this past report is because we lost 451,000 people in the population. The population actually shrank by 451,000 people last month. Now, as you can see, those red bars at the bottom are very rare. That's when population decreases for some strange reason. But the only reason that some of these numbers look better on a reported basis is because there was a big contraction to the actual population change. So, again, it's just one of those. Normally, the population kind of ticks along every month. We add 200,000 people to the rolls, whatever it is. This is everybody 60. This is working age population, so 16 years and older. We normally add a couple 100,000 people a month, and then all of a sudden last month we just had this big 451,000 person decline. So it was just very interesting.
Is that an adjustment?
Sorry.
Is that an adjustment? Is it? Do they periodically go and just? It's not like happened in the past month, right?
Right. No, you can kind of see that every now and then, like somebody comes in and says, "Oh, we need to adjust that," and that's where you get these big red declines. But that's the only reason. If it wasn't for that adjustment, the full-time employment to population number would be a lot worse. And the important thing about that is that when you see these big declines in full-time employment relative to population, that only occurs as the economy is actually going into recession. So you kind of go back and look at these previous periods like 2008, 2019, early 2020, back in heading into 2000. You see these big drops in full-time employment to working age population because this is where companies are going, I'm done hiring. And all of a sudden you get layoffs and those type of things occur. So we're seeing something that says something vastly different relative to what the BLS is reporting.
Exactly.
That's the whole point.
And if I can, just let me read this real quick. I won't read the whole list here, but this is a list of recent layoffs. Twitch laid off 35% of its workforce. Hasbro, 20% of its workforce. Spotify, 17% of its workforce. Levi's, 15% of its workforce. Xerox, 15%. Qualtrics, 14%. Wayfair, 13%. Duolingo, 10%. Washington Post, 10%. eBay, 9%. Business Insider, 8%. PayPal, 7%. Charles Schwab, 6%. And then UPS, BlackRock, Citigroup, Pixar have all also let thousands to tens of thousands of employees go. My point here being is, again, this is the data we're seeing when we're looking out the window. These are the storm clouds. This is the rain and the lightning we're seeing. And yet, the BLS is saying, hey, nothing but sunny skies, right? If this happened once, fine, but we've seen this a lot, and we're now getting to a point where I think the disconnect, and you showed that chart between the establishment and the household survey, that it's at its greatest discrepancy so far. I think it's getting really hard to look at this as anything other than this is just as much lipstick as you can smear on that pig in an election year.
Yeah, there's a lot of comments about that, about this is, just manipulation and
Well, prove it wrong. What's the contrary?
Well, no, I'm not saying it's not. I'm just saying that, the BLS is always wrong. I mean, it's I think it's more heightened. I think people notice it more when it's in election.
But they're a lot wronger. Yes, they're wrong, but they are a lot wronger than normally right now.
But the thing is they're always wrong, and then we don't find out how wrong they are until there's an actual revision to the data later. But we don't care about revisions. Nobody ever goes back and looks at every year and every 3 years we get these big data revisions like on GDP, things like that. Nobody ever goes back and looks at those, how wrong they were for so long. And we based all of our monetary policy decisions, our fiscal policy decisions on this data that was flawed from the beginning. And so, is it really manipulating it, put the stick on the pig, lipstick on the pig for the election? Maybe. I mean, they are a government agency, but I think it's a function that their data collection process is hugely flawed. Their mathematical adjustments are hugely flawed. Their birth-death adjustment is a complete farce. So, because none of that has anything to do with what really happens, in the world. And if the BLS wanted to be honest, I run this analysis, is that if they wanted to really be honest, use the non-seasonally adjusted household survey and just use a 12-month moving average. And you get a much more accurate employment rate over time than you do with all this other nonsense that they pay hundreds of government employees to do. It would be one guy with a pencil and he could do the whole job of the entire BLS.
Well, yeah. So, simple solution, never going to happen because it's simple and easy and smart, right? All right. So, well, the last point on this was just because one of the reasons, folks, why this is so important is because many of the analysts I've interviewed on this channel, and I myself also strongly share this opinion, which is that like one of the key linchpins in the whole story here is employment, right? That's really, as goes employment, will go, the soft, hard, no landing scenario, right? And if you look at what's being reported right now by the BLS, it's like total no landing, nothing to worry about, right? But if those indicators are faulty, one, then the headlines are deceptive. But two, if that's what's driving monetary policy, right, or monetary and fiscal policy, then that is akin to a pilot, piloting a craft with faulty instrumentation. We've used that analogy many times in the past. And Lance, yes, we all agree that the BLS instruments aren't good in general, but there's a big difference if your altimeter is off by a couple 100 feet versus many thousands of feet, right? And it's beginning to feel like it's the latter.
Yeah, but here's the important, it's a great point, right? And I'm not saying you're wrong, but the market doesn't care about that, right? So, and this is the important thing. Look, the markets are surging higher on Friday on this employment number. Now, that employment number is actually bad for here. Let me show you something real quick because this is what's going on in the market. So let me just pull up a heat map of the
Okay. Well, as you're pulling it up, let me ask this question for you to respond to, because I think it's where you're going there, right? Which is like,
I don't think so, but go ahead.
Okay. No. All right. Well, then you go.
No, I was just going to say, look, if you take a look at the markets today, the markets are up strongly on Friday, but it's only a handful of stocks. It's Amazon, Meta, Nvidia, Microsoft. It's all the big mega caps.
Right. It's Groundhog Day. Yep.
It's Groundhog Day. So the point is that super strong employment number says that the Fed is not going to hike rates anytime soon, and the market completely shrugged that off and said, yeah, you're still going to cut rates. Maybe it'll be April or May, but I still think you're going to cut rates. And so boom, immediately we go right back into the chase. Here's my point about this. So let's just say you're absolutely right, Adam, and that the employment data is entirely wrong. I mean, and I'm not, let's say it's wrong by 50%. And we only had let's say it's even worse that we actually had no employment last month. We had negative job growth. Okay. It doesn't matter, because all the market is going to look at today is what was that number and what's the implication of that number. Now, when we get the revisions, you may very well be right. 6 months from now or a year from now, we'll get the revision and say, oh yeah, look at that. Adam was right. In January, we had negative job growth, but the market's going to be 30% higher.
Right. It'll be too late to matter. It'll be ancient history.
Yeah. And the market will have already factored in the fact that the employment data has changed. So, I'm not saying that it's not, don't misunderstand what I'm saying, Adam, and anybody listening, don't take me what I'm saying is wrong, because I do all this same data, right? You saw the charts. I was building charts this morning to analyze the employment data. This stuff is important, but just understand that the markets can remain irrational for a lot longer than you think. And the markets are focusing on the data that they have today. The market doesn't care about revisions. By the time that data gets revised, we'll be off onto a whole nother story that we're looking at. Well, yeah, job growth was a lot weaker than we thought, but look, we're over that hump and now it's the new horizon. Employment should be coming back. We got through the trough or whatever it was. The markets are always looking forward. So, if you're hinging, here's my whole point, is that if you're hinging your entire portfolio analysis structure on valuations, which are important. Valuations are very important. I did a whole segment on valuations in my presentation on Saturday.
Right.
Valuations are very important in the long term.
In the long run. Yep.
Yeah,
I know.
They're not important this month, next month, this year. Valuations are not important. It's all about momentum. Economic data is not important unless it's something totally shocking. Like what would have actually shocked the markets this morning, maybe good, maybe bad, was maybe that number being a negative 150,000 jobs. And all of a sudden the market had to start pricing, yes, we're going to get rate cuts, but are we about to have a recession now?
Right. What's that? Yeah.
And what's that going to do to earnings? So, these are the challenges that we have as investors. And again, this isn't a healthy market. Nobody's arguing that. I did a whole series of charts about the bifurcation between S&P market cap weighted and equal weighted. And we have this big, and this year is another good example. S&P 500 market cap is just crushing equal weighted stocks right now. So, if we run our portfolios kind of on a blended basis. And so, we're our performance is tracking the S&P right now because bonds have been doing great this year. But outside of that, we would be lagging because we don't own just 7 stocks. Or 6.
Right. And again, Groundhog Day again. Okay, so this is going to the question that I was going to work up to in this discussion, but I'll pull it up now, which is so the Atlanta Fed's GDPNow tool just increased its expected Q1 GDP up to 4.2%.
That'll be higher after today.
Okay, so here's my question, right? So let's even say, okay, so let's say it goes higher, right? So you have higher than 4.2% expected GDP growth, and you've got just blockbuster jobs, right? How can the Fed accelerate cuts into this environment, right? It's like, hey, this is an economy that is doing great. Maybe we need to start talking about overheating if we're looking at these official numbers, right? I mean, does that somehow, is that in some way make it harder for the Fed to deliver on the 3 rate cuts this year? Because it's like, why?
Well, this has been my argument all along, which is this is nirvana. If I was the Federal Reserve chairman, right, and I've got 5% rate hikes, Fed funds rate sitting on my books right now, and the economy's doing fine, markets are doing great, employment is fantastic. Why would I cut rates? I would just leave them there. And then when the economy, when that higher rate, that lag effect of higher rates actually started to kick into the market, then I have some ammo in my gun, so to speak, that I can start cutting rates to, kind of boost the economy a bit,
Yeah,
right?
exactly.
Sort of try to stave off recession. At the same time, I would be rapidly cutting QT. I would have doubled or tripled QT by now. Really started reducing that balance sheet. Yeah, it might cause some problems for some of the banks, but you got to resolve your own issues at some point. You got to grow up and be big boys like everybody else, but be working off that balance sheet. So I had that room at some point in the future to start monetizing debt that the government's going to need to issue. So, this is, look, I have tons of flaws with government. I thought the government, when interest rates were zero, and the 10-year Treasury and 30-year Treasury were trading, below 1%. Why didn't you refinance all the Social Security debt, right?
Yep.
There's so many missed opportunities to kind of fix some of the financial system that just, went away because we were too worried about bailing out the banks or supporting people. No, the reason the Fed's going to cut rates regardless of this data is because of what's going on with the regional banks. You just had the bank in New York, got hit on Wednesday, Thursday, whatever it was. The liquidity and the reverse repo is running out very quickly. And this all comes down to the member banks of the Fed, and they're going to make sure that there's plenty of liquidity there for those guys. And the Fed's going to have to start monetizing about 30% of the Treasury debt issuance. So again, they really don't have a choice. So yeah, economic data is great, but yeah, they're still going to cut rates. And
so you're putting your finger right on the heart of like my angst here, right? Which is like, it feels like we have this like, well, it feels like we have this how do you pronounce it? Potemkin system, right? And for those that aren't familiar with the reference, it was back during the Russian Tsar era, where they didn't want to disappoint the Tsar as to how bad things truly were. So when he was making this cross-country travel, they had this crew going ahead of him, basically building these facades at every village he would go through that made it look like a really prosperous village. And then his car pool would go by and they'd dismantle it and then they'd go rebuild it, at the next one. So yeah, it's like everything is awesome, right? Which the markets are taking that and saying, okay, great, this is our rationale to go higher here, right? But kind of nobody believes it. Right. It's like your point. You're like, hey, you know what? The Fed's actually running scared about a lot of these things, and it's going to cut for these reasons. We just talked about the jobs market probably not being nearly as sanguine as they're selling us. So it just feels like, again, we're just kind of collectively lying to ourselves. And as long as everybody truly believes in fairies, Tinkerbell will continue to live here. But that's not, that has a reckoning at some point, right?
But again, that reckoning, and look, absolutely, at some point, there's going to be a price to pay. But this is the problem that I've told you about before, is that I have clients that come into my office now that have been out of the market since 2009 because they kept believing that at any moment the face was going to come off, this market, and all this money would get lost and they were going to be there. And it's 500% higher than it was. And, they're just finally feels like, I got to get in. I've got to get ready for retirement. So, that's the whole point about this, is that right now, this is a market driven environment. You need to be long stocks. If you've got a really bearish bent to your portfolio, you've got to start changing that. Now, eventually, and look, use corrections. We're going to have a correction sometime the next few months. Use that as correction to start moving some money back into stocks. But this is going to be the play for a while. And look, and when it begins to change, we're going to know, right? All indicators will start ringing off bells. It'll say, hey, the trend is breaking. And yes, you're going to lose a little bit of money off the top. You'll be down 8, 9, 10% from the peak, but then you'll get out and you'll be able to avoid the 20, 30, 40% draft that comes after that.
Okay, so let's dig in that just a little bit. So totally agree. And that's why I made the whole speech about being Eagles earlier, right? But I'm sure many people have this worry, which is, all right, Lance, and because you're a capital manager, how do you avoid the Chuck Prince fate, right? Which is, hey, you know what? In this business, when the music's playing, you got to keep dancing, and the music's still playing, so we're still on the dance floor, right? How do you have confidence that you as a capital manager can see the warning signs and get out with a flesh wound versus, you know, an amputation?
Well, like I said, look, every week we go through the charts and the analysis, and there's a lot of great managers out there that have avoided big downturns in the markets, right? They participated in the way up and they missed a lot of the downturn. We in 2008, our portfolios were down about 8%. In 2020, our portfolios were down about 8% versus 35. So, it's when you start to see these turns, and I wrote articles in February of 2020 saying, hey, we're taking money out of the market. We don't know what's coming, but we feel something's coming. And we took exposure out of portfolios. So those things are there. You're gonna see them. I mean, the markets are good at predicting outcomes. I said this on the other day. I was doing a radio show the other morning, and this is what I was explaining. And it's the same premise, which is, here's how you know the difference. Anything that you can think of right now. So Adam, give me your top 5 geopolitical, or 3 or 2. Just give me a couple. What are the couple of big things that are keeping you up at night right now?
Yeah, I mean, I'll come up with something, but I know your point, which is whatever I can think of, the market's thought of and priced in.
Right. All right. And that's right. So if you think it's Russia, Ukraine, if you think it's Israel, Hamas, if you think it's, what happened in Iran over the last week with the 3 soldiers, if you think it's any of that stuff, this is how you know. Go flip on CNBC. What's the market doing? Is the market up or down? And if the market's up, that ain't it. That's not the thing, right? Here's how you'll know. When you wake up one morning and there's some event that occurs overnight, and you wake up in the morning and the market's down 3, 4, 5% in the morning, go sell everything, because that's the thing that the market wasn't expecting. And that's the way markets work. So markets all are about liquidity. And as long as as long as there's buyers and sellers meeting demand, the market's going to just do what it's doing. At the moment that an event occurs, and again, this is why it's always some expected exogenous event that we're not aware of. It's something that all of a sudden the market wasn't looking at, and it goes, oh, damn, I didn't expect that to happen. I've got to reprice now for this event, and that means I've got to do this. And that's where you just get sellers en masse in the markets, and you have this big decline. And that's going to last. If that occurs, that's going to last for days. So yeah, you're going to clip 3 or 4% right off the top, getting out. That's just part of the deal. But you're going to miss whatever that downside draft is until the Fed steps in to start to bail it out. And that's what happened exactly in 2020. We were going down a little bit. The pandemic was showing up, and we were down 5, 6, 7% from the peak. And all of a sudden, that was when President Trump stepped in and said, yep, we're going to shut down the economy. And then it was 30% lower right after that. And then at 35% down, the Fed says, hey, guess what? We're here. Mm-hmm. And, 1.2 trillion in QE, buying junk bonds, sending checks to households. And then the market started to recover. So, I mean, that's what you're looking for. You're looking for that event where you flip on CNBC and the markets are falling apart. That's your sign to get out.
All right. Well, I appreciate you answering that question, because I said I know a lot of people have that concern about, well, if I'm in, how do I not get just thrown into the meat grinder? When the process you just described is another big reason why we so often recommend that folks work with a good financial advisor, right? One that actually has that perspective, knows what to look for, can take action, when needed during those shock surprise movements to protect you on the downside. And to be honest, most people, when that happens, Lance, when you flip on CNBC and it's down or whatever, most people are at work, right? Like they've got they don't have time to rush and figure out what to do, right?
Right. No, that's what I'm saying, though. Here's the mistake that people make. Yeah. So you're at work, right? You get home in the evening and the market's down 5%. Load up your orders for the next morning and sell. Here's what people do that winds getting them up in a trap. Okay, wow. The market was down 5%. So as soon as it bounces, I'm going to sell. And then the market's down 5% more the next day. Okay, well, if it bounces, as soon as it bounces, I'm going to sell. I'm going to get out as soon as this thing bounces a little bit. Maybe get me back close to where I was. I'll get out. Now they're down another 5%.
You start pleading with God. Yeah. Oh God, just have it go back to where it was, and I promise I'll sell. Yeah.
Exactly. Right. And so we all find religion and foxholes in the stock market. The point is though, is that you don't worry about that. When you come home from that, whenever you get home from work and the market's down 5% a day, you just sell everything. Figure it out later. If the market goes up the next day, who cares? Buy back in. See, that's the other part that people make the big mistake on, is that they sell and then they never get back in. So, you can't worry about, the big mistake that every investor makes is they don't want to be wrong. We're all going to be wrong. I'll give you my number one big wrong. I bought Meta right before earnings in October of 2022.
Yeah, I remember this program here watching.
And the stock went down 20% the next day. We got stopped out, and then I got off doing other things, and I never bought the stock back. And now the stock's up 400% from the lows. Now we made money elsewhere, but huge mistake on my part. We all make mistakes, but you can't worry about being wrong. It's okay to be wrong. Just don't stay wrong. That's the thing, right? And so once you're wrong, just reverse it and get back into the game, and then the next opportunity comes along, adjust from there.
Well, so that's all totally true. I just think though that, Lance, that the vast majority of people, like real life people, they come home at the end of the day, they flip on CNBC, oh my God, the market was down 5%, and they're in shock. Right. And I think they're in shock for a good while, days, weeks. Like, I just don't know what I should be doing here. They might not even be in that bargaining point with God. Right. And again, this is sort of why, especially when things get really emotionally charged because things are moving faster than most people realize. Again, this is the discipline that a good financial advisor, who's seen many of these before, had a plan in place for this, is reacting smartly in real time, can be a huge benefit for most people who are just in that flooded state by emotion. So anyways, got to move on here. So I asked the big question of, can the Fed cut here, right? I think I have an even bigger question for you, Lance. And then we'll move on to your trades, and then we'll move on to our rant, which is, okay, so we've got these gargantuan deficit now, right? We're doing, as a percent of GDP, we're doing spending, fiscal spending that we've only seen in times of real war, right? And I'm not talking about proxy wars that, maybe being fought around the world right now. I'm talking like sending, hundreds of thousands to millions of troops abroad, rejiggering our economy to support the war material and all that stuff, right? Now that we have flipped the fiscal spigot to 11, right? We've dialed it all the way up to 11, and it's now kind of becoming business as usual. Can it ever go back, right? Or will that just be so politically unpopular now that nobody's going to be the one to say, hey, you know what? We've been extra generous for a while. Now we have to tighten our belts a little bit and take some austerity. Is there a politician that's going to say that now, or have we crossed the Rubicon where it is just eternal maximal deficit spending?
Well, look, we've been slowly, we talk about before, it's the frog in the boiling water. So, we talk about deficit spending, and deficit spending has been on a growing trend ever since 1980 when Reagan took office. And, prior to that, we didn't really run a deficit. We pretty much had no deficit, but it's beginning in 1980, because at that point, Ronald Reagan's having to fend off 2 recessions before him. He's trying to get an interest, Paul Volcker's trying to bring interest rates down from, sky high levels. So they start doing some deficit spending. And then, which was, right in line with Keynesian economic theory, which was that during a recession, you do deficit spending until the economy gets back on track. Well, what politicians heard is, oh, you do government spending. What they didn't hear was the part that they didn't like, which was after the recession is over, you go back to a surplus. That's Keynesian theory. Well, we just never did that. So we've been slowly just ramping up deficits ever since 1980. Now we have these periods where we go crazy with deficit spending, like during the financial crisis in 2008, we had a big surge in deficit spending. Thank you very much. During 2020, we had a big surge in deficit spending, and now we're starting to ramp up deficit spending again. And the only reason, by the way, that the deficit reduced in 2021 and 2022 was because we didn't renew the fiscal stimulus that we did in 2020. So that was the only reason the deficit declined. And now the spending that we're doing, this ongoing spending that we're doing is now ramping up that deficit again. But if you just draw a trend line, you can see where that trend of the deficit is going. So to your point, Adam, yeah, this is the new world we live in since 1980, which is more deficits, the better, because what politicians figured out is that if I do deficit spending, then that creates economic growth and I get reelected.
Yeah, I mean, look at this. This was the third highest year. So 20, yeah, third highest year, third biggest deficit relative to the record set during COVID, right, where we shut the global economy down, right? But now we have 4.2+% GDP growth that we're expecting. We've got, you know, Goldilocks jobs market, inflation's coming down. It's perfection looking at the official data, right? And it's like, if we need this level of fiscal spending in perfection, what the hell?
Well, look, I mean, put it this way: in Q4 of this past year, right, the economy grew at 3.3%, according to the BEA. We spent $2.50 of debt to grow that 3.3% growth in the economy. So it's taking more and more debt to create that economic growth. So if you don't have debt issuance, if you're not running a deficit, you're not going to have economic growth. You're going to have negative economic growth without deficit spending. So the question you asked me was, is this the new thing? Yeah, this is the new thing. We're not ever going back to running a surplus because we can do that. And as Mike talked about during his speech on Saturday, is that you can certainly get back to a surplus and we can certainly get this economy back on track, but you're going to have to go through a depression first, and nobody wants to do that. Here's the other side of that as well, is that, you know, if you take a look at the wealth of the top 1% versus the wealth of everybody else, that's crossed. And now own more net worth than the rest of the entire economy combined. But this has been a function that's been going on not forever, because back in the 1970s, 1980s, there was actually a decent equilibrium between the top 1% and everybody else. And they kind of just tracked each other wealth-wise. But beginning in 2000, when we started doing monetary interventions and stock buybacks have gone crazy, et cetera, it has been a big wealth extraction out of the middle class. So we've just been drawing more and more wealth from the middle class and shifting it to the top 1%. And that's not going to change either, because that's the way our market and our economy is driven right now. I mean, take a look at the stocks running today in the market. Meta, billions, it had a huge surge in advertising revenue. Okay, think about that for a moment. If Meta is making billions of dollars in advertising revenue, that means that more and more people are buying products off of Facebook, right? Or Instagram, since they own Instagram too. Same thing for Amazon. And same thing for Google. So yes, companies are advertising on these platforms to sell you product, which means the more of these things that you click on and the more things that you buy offline and more stuff you get sucked into on social media, you're sending them your money, right? So it's extracting your wealth and it's transferring it to these companies. So you keep living poorer and they keep making more money, but that's the society that we're in today.
Well, in the 10% of households that own 93% of stocks, you know, they're getting even richer as the share prices of those stocks go up because of that dynamic.
Right. Exactly. But again, that's the whole part about, and look, the bottom 80% don't own stocks. So that's just more wealth that gets extracted from the middle class. And then this is why this was the article from last week on the website, why, you know, despite booming economic data, Joe Biden's got the lowest opinion polls, you know, popularity ratings, you know, kind of any president. And you got this perfect economy and you've got really bad poll ratings. That's because the average American isn't buying into it, because they're not participating
in it. Yeah. In fact, they're suffering. They're in many cases, they're you know, retrograding.
Exactly.
So I talked about this a bit with Sven, and he raised a really good point, which is, He's like, look, the problem is that this is the system now, right? Where, so you just said that it's going to be continued mega deficit spending going forward, and the Fed's going to have to monetize all this stuff. And as a output of all that, this wealth gap's going to continue to accelerate, right? And so the question is, well, all right, well, why don't we just see that that's a bad thing, and why don't we try to get under control? And to your point about how if we removed that, then we would have negative economic growth, right? We'd have a recession. Maybe some folks might even want to argue with depression, right?
Right.
And so it's this hostage situation now, right? It's like, oh, you don't like it? Well, look, then we're going to have to shoot everybody in America economically in the head because we're going to have this massive, recession or depression. Who wants that, right?
Right.
And nobody wants to raise their hand and say, oh, yes, please, let's have a depression. But until there's some sort of big correction in the system like that, it's just going to continue in the direction that you were talking about, where more and more of the wealth and advantage and opportunity concentrates in the pockets of fewer and fewer households going forward. Right. And what worries me about that is the systemic break is almost the better choice at this point in time, because the other trajectory ends in American oligarchy, but also probably in some sort of real social breakage, right? Where the armies of the dispossessed finally get to a breaking point where they just say, this isn't working for us anymore. Now, is that 10 years in the future or 100 years in the future? I don't know. But that's basically, a civil breaking and uprising after we've basically destroyed the opportunity for all premise that this country was founded on. So I don't know. When you asked me earlier, like things that keep me up at night, it's actually less the geopolitical stuff and it's more the socioeconomic stuff.
Right. Look, and look, it's plenty of evidence around, that around the country. It's very interesting that, social media as an example is not making our world any better. And, it sounds great. It connects people. I was listening to Mark Zuckerberg, in front of Congress testifying.
Yeah, I did want to note that Congress did finally pull the social media companies and kind of quote unquote held them to account. Now, it was a lot of political grandstanding by a lot of the guys there, but yeah, go ahead.
Yeah, it's funny, the hold them account, they never do anything about it. But they were asking about, have you fixed the problem of the stuff you're showing to young children? That's a super simple fix. You can't drive a car till you're 16. You can't enlist in the military till you're 18. You can't buy alcohol till you're 21. Put an age limit on social media. If you don't want your kids, having access to, suicide data and all this other type of stuff, put an age limit, right? You can't get on social media till you're an adult and you can figure out what's going on with it. I mean, so there's some super simple fixes, but you look at the world, you look at depression rates, you look at suicide rates, you look at wealth disparity rates, all those type of things. And there's almost an exact correlation back to 2010 when Facebook first went public.
Yep.
And ever since then, as social media has progressed since 2010, things have gotten markedly worse in society. We have more division, more anger, more people are upset. We have racism come back now. We gotten rid of that for decades. Now it's back. It all stems from social media. So there's nothing good coming out of social media, but yet we're driving our whole lives around it. And now we've got a whole market that's driven around nothing but that.
So I agree wholeheartedly with just about everything you said. I am going to say a little bit later something that's actually good that's coming out of some of these social media platforms, because that's what we're talking to people through right now. But I totally agree. And as folks know, my wife's a therapist, a family therapist. And I mean, for the past 15 years, she has seen the rise of everything you're talking about, but at a very visceral level with the families that she's worked with and the kids, who have been just toxically infected by all this stuff. She also has, I know at least one client whose role is to basically watch the horrible things that get posted on social media to determine, okay, do we need to take that down or not? And it's terrible. I mean, it is terrible.
Well,
it is.
And there's the thing, right? What's your job? I watch horrible things get posted on social media to determine if they should take them down. If it falls in the qualification of horrible, it comes down, period.
Yeah, right? But somebody has to determine, someone has to watch it to determine it's horrible. That's they're like the infantry cannon fodder that has to watch and no wonder they're in therapy, because it's headings, it's horrible things with children. It's just terrible. So yes, there's so much about this that's corrosive, and would we be a better society if we didn't have it? Absolutely. Yeah.
Well, it's funny. I see all these videos on TikTok. It's like, how did you Gen Xers stay out of the culture war? We didn't have social media.
Yeah.
We were outside playing with each other. And if we had a disagreement with somebody, we punched them in the nose.
Right.
That was the way it worked.
We had to invent our own fun. We had to manage through all of our interpersonal relationships. It's so funny.
Maybe if you went back to that, things would be better. Anyway.
Well, what's crazy is like, I was just saying this yesterday, Gen X is we're both Gen X, right? And Gen X and boomers, but Gen X are taking over from boomers now that boomers are aging. We're kind of becoming the like wise, elders here to the millennials and the Gen Z, and saying, hey, back in our day, we didn't have this stuff and we had to figure this stuff out on our own, right? And Gen Z has the slacker generation, knock against it. And being honest, like, not for nothing, right? And the fact that now, like, maybe the world is hinging upon the wisdom of Gen X, like, that's probably not the best place you want to be. Like, that's not a sign of excellence, right? I'd rather have the guy who fought World War I advising me, like, those guys knew how to do stuff, right?
Yeah, no. And you're talking to a generation that was shooting bottle rockets at each other and throwing yard darts.
Exactly. Right.
So, yeah, it's not necessarily the best generation to go to for wisdom, but hey,
could be the guys that won World War I and World War II and built America with their bare hands, or the guys that can recite Beavis and Butthead and have burn scars from bottle rockets.
Exactly.
All right. Well, look, moving on. We'll revisit your retirement savings next week, Lance, just because we're beginning to get a little bit tight on time here. Trades. What trades have you guys made over the past week, if any?
So we did a few trades this week. The vast majority was in the building out of the dividend equity model. So, like I was saying earlier, we bought last week, we bought Meta, Apple, Google, because that dividend equity model is 30% the Mag 7, 70% dividend yielding stocks. So you get the S&P performance with a higher dividend yield. So that's mostly what we did last week. Today, as I mentioned early on in the show, we're lengthened the duration in our bond portfolio. We switched 5% of our short duration bonds, 1 to 3 year, to 7 to 10 year bonds. So that was kind of the big change. The equity model and the ETF model really haven't needed a lot of changes. It's been performing well. It's a 60-40 model. And as of yesterday, the performance on a year-to-date basis was just only slightly below that of the S&P 500. So it's been tracking fairly well this year. We're outperforming our benchmark by a pretty hefty amount at the moment. So again, we've kind of got the right mix so far this year. We'll see if that remains the case, but at this point, it's doing fine.
Okay, so perhaps the fundamentalists of you may not love this market, but the portfolio manager in you is enjoying it.
Yeah, I mean, it's just like today. The portfolio is doing okay. It's not doing as well as the market, because what's driving the market today are 5 stocks, basically 6 stocks. We own those stocks, but you look at the good fundamental companies that actually grow earnings and have a good fundamental value. They're all negative today. So, that really kind of tells you what's going on in the overall market. But, again, it's just that's the market we're in. And, we have to be a little bit prudent about how much risk we take in a portfolio, because again, we're, as our article today was talking about retirees taking on too much equity risk, there is a risk to that if something goes wrong and you don't have time to recover. So, we always run a portfolio that's got some built-in hedges to it theoretically. And that's kind of the idea behind the dividend equity growth model, which is that in an environment where money rotates out of these big mega 7, it should rotate into these dividend yielding stocks that have high dividend, lower volatility. So that portfolio theoretically, in theory, right? So this is why it's in beta right now. And we're going to run it for 3 months at SimpleVisor. And then we'll pull it out for our clients to invest in, because there's a lot of demand for it. We got a lot of clients that want that. I've had a lot of requests for it, but I want to run it for about 3 months. But the volatility should be relatively less than the markets, but then we get relative performance and a higher yield. So that's the goal that we're going to try to get to.
Okay. All right. So I got two things I want to address in our rant. The first one is it's about media. We're seeing a pretty big correction. Some would even say wipeout across the media space right now. Let me just mention a couple casualties recently. So this week, the Messenger was shut down. If you're not familiar with the Messenger, don't feel bad. It was around for less than a year, but it's kind of interesting. It was created to be kind of a new big thing in media, and in this very partisan media landscape, this was going to try to chart a more agnostic course. And they raised 50 million for it, and they burned through it all in a year. They shut down the company unexpectedly. In fact, most of the employees found out about it through other media before they heard about it from their own company. But in the last month, dozens of layoffs were announced at outlets including NBC News, Time Magazine, Business Insider, and the Los Angeles Times. Sports Illustrated is shedding a significant reduction of its 100-member workforce. Staffers at Condé Nast walked off the job over the company's plan to lay off staff, and the Wall Street Journal shook up its DC bureau with big layoffs. So we're seeing, and we've talked about this a bit in the past, Lance, people, the traditional media model really suffering. And I think a big part of that is because eyeballs are leaving. People are spending less time in these outlets. And the reason for that, which we've talked about in the past and relates to the financial mainstream media, is that people are just not feeling well served anymore by it, right? And number one complaint we get is by folks saying, I've left CNBC because CNBC basically is an eternal market cheerleader. No matter what happens, it's always a good time to buy stocks. And that's largely because their big advertisers are these big ETFs, right? And so they want to keep their advertisers happy. Also, CNBC, a good example of just wanting a soundbite, right? It's more entertainment than it is actually actionable information. And so that's one of the reasons why people are coming online to sites like this one to get what I consider to be, or what I call more financially nutritious information. And so where I'm going with this, folks, is there is this sea change that's going on in media, and it is probably the principal reason why Thoughtful Money exists and has been doing fairly well so far, is because hopefully we are providing a better service than folks are getting elsewhere, right? And we have these long form discussions here so that we can really get into the meat of the data. We try to keep it very, focused on the information versus trying to just be entertainers. And fortunately, that seems to be working fairly well so far. But what I want to point out here is that what gets supported in terms of one media versus another is the one that's supporting the viewer's needs. And we try to do our best job of that here, but it's a two-way street, right? There's only so much that I can anticipate or that I can glean by instinct or by data. And it's really hearing from you all what's most important to you. What do you see? What are we doing well? What do you want to see more of? Where are we falling short? What improvements would you like to see? So this is basically just a big ask from me to say, first off, thank you all for your support and your viewership and everything that's allowing Thoughtful Money to exist. But also, please keep the dialogue going. When you comment in the comment section, I do read every single comment here on YouTube. When folks email us at Thoughtful Money, I read every email. And just for the record, the email address there is support@thoughtfulmoney.com. So if you have something to say, I guarantee that I will listen to it. Can't always guarantee I'll act on it. We can't meet everybody's wish, but certainly in the aggregate, we listen to what people are telling us and then take action from that. Lance, just curious, because you've been in the financial media industry for a long time. Anything to add to that?
Yeah, no, I mean, it's the legacy media like Wall Street Journal, et cetera, they really hurt themselves because they become very partisan, right? So they only report one side of the news, and there's been clear suppression of data that people aren't stupid, right? And that's one reason that we do all of our own research. People ask me like, "What do you watch?" Or I don't watch anything. I'm not on social media. I go on Twitter in the morning. I post charts.
Except TikTok, apparently. It sounds like you spend all your time on TikTok.
No. I know this is how people send me. I get all kinds of emails from people, right? So But, I don't go on social media especially during the day, but in the morning I'll post stuff on Twitter and I don't return to it till the next morning. And then I post stuff and I leave, because all that distracts me from the data. So everything that we do internally in terms of, the news or the data or whatever it is, we're doing our own data crunching, right? Because we just find the raw data and we just crunch the data. And, during the COVID pandemic and during all that, there was just all kinds of false narratives being put out to the media, and they were very easy to prove with the data, right? But nobody wanted to hear that. And, people want to argue, and then they just want to present their side and they don't want to listen to the other side. And we can't have conversations about anything. So that division is just driving more and more people away. Speaking of the editor of the Wall Street Journal, she was at Davos, and she said straight up, we don't control the narrative anymore.
Yeah.
And we don't control the news. And that's because that's their short-sightedness. Fox News has fallen in this bucket. CNN.
Yeah, they lost the trust of their viewers,
Exactly.
and they worked to do so. It wasn't a mistake. I mean, it was something.
No. Yeah, they worked really hard at blowing the trust of consumers, and so consumers are now. And the other problem now is we talked about this before, just about people being feed to death. Right. If everybody's got a Substack, everybody not Adams is worth it, but everybody's got a Substack, right? Everybody's got a pay for channel. Everybody's got a pay for newsletter. And, people that are trying to make ends meet, they've got, every time they have a service, the service is raising a fee on them. And then somebody else is, if you want to read this article, you got to pay $3 a month to read this article.
They all paywalled. Yeah, exactly.
Yeah. And so now consumers are having to be much more conscious about where they get their data and where they're getting their information. And, individuals are becoming much more selective about where they're getting that information from. And the problem with a lot of these legacy media is, Business Insider is a great example of this. Very partisan, one-sided reporting from their site, and they're paying that price for that now because people are going elsewhere where they can get better data, better information, and in a lot of cases get it for free.
Well, let me be transparent about this too. So one of the cornerstones of what we built here at Thoughtful Money is a content production platform that provides the vast majority of the content and as high quality content as we can create to the world for free. Right. And being super transparent about that, folks, the way in which we fund that is, and I think that this is the right thing to do anyways, is we encourage people to work with a good professional financial advisor who understands all the macro issues that we talk about here. Right. As I say every week, if you've got a good one who's doing that for you, great, stick with them. They're really worth their weight in gold. But if you don't, feel free to have a free conversation with the financial advisors that you see on this program with me every week. Lance, the guys at New Harbor, Jonathan Wellham from Canada. It's totally free. It will help you, right? You'll get good information, good quality guidance. You can do with that guidance whatever you want, right? You can do a DIY strategy. You can give it to your existing advisor and say, hey, I thought these guys were smart, do this. Or if you like the advisors, you can talk with them about maybe working for them. And some percentage of people do that. That provides the revenue stream into this whole platform that allows us to offer everything up for free. So, that's what we've tried to create here, is basically a virtuous system that benefits everybody, but allows us to help as many people as possible by keeping a free product widely distributed. And I think more of the media should try to find models like that and not just kill people with fees or paywalled content or everything else that you were just talking about, Lance. So anyways.
Look, at the end of the day, the consumers is going to drive this. I was mentioning earlier is that, my wife and I are watching the Reacher series on Amazon. So we've had Amazon Prime, forever, right? We have one account that she and I share. And so that gives us access to Prime Video. And so the other day she got back from her trip and we sat down to watch another episode of Reacher, and it says, this video will now contain ads unless you want to pay another $2.95 a month.
Yep.
And I kind of chuckled and I looked at my wife and I go, honey, look at this. I said, we're finally going back to the way it was when we watched TV growing up, because TV was free and you had commercials and nobody cared, right? And so, I think we're going to see a shift back towards bundling of services. We were going to cut the cord, get rid of bundling, and that was going to be cheaper for everybody. Now it's gotten more expensive. So I think we'll see a push back towards bundling. And I think we'll see a push back towards free television that has ads. In other words, we're just going to go full circle. But I think we'll see this with news content. I think ultimately, these news outlets are going to figure it out that what consumers want, by and large, is just fair, unbiased reporting. Tell me both sides of the story. Let me determine what I want to believe, but give me both sides. If it's over the border crisis in Texas, give me both sides of that story. Let me determine what's good with that and what's bad with that. So I think there will eventually be a push back towards that, because we've gone to propaganda, not news.
Yeah, no, I agree. And again, I think that's one of the reasons why channels like this are doing so well is people are starved for just impartial information. Like, look, just give me the facts, or if it's cloudy, let's have a debate and let's have this be an exploration to try to understand what the truth is, right? As opposed to, we've got two people with opposing sides and they're just shouting each other, or we're trying to cram, as you said, propaganda each other.
Or you're suppressing data, or you're not giving the whole story, or whatever.
Right. But to your point, I think what consumers are really hungry for at the end of the day is just value, right? I want quality content of whatever type of content I'm looking for, information, entertainment, whatever, at a price that makes sense to me. And I fear, and you talked about, the prime example of them saying, hey, we're going to start shoving ads in this stuff unless you pay us, is there's this sort of like business model that's emerging that it's like, it's suckification is sort of how I think of it, right? Which is like, hey, we're going to make this suckier unless you want to pay us more, right? And I don't think that serves consumers well in the long run either. You might be right that we might kind of go back to the future on some of this stuff, but I was transparent about our business model because I think there are models out there that can be win-win-wins for everybody, right? But we're not pursuing them.
Right. And more people would, if the consumer would do what they should, which is to vote with their dollars. And, if you don't look, for instance, as an example, then this will never happen. But let's say that you're opposed to Netflix raising their fee again, because they're about to raise it again. And then they're going to have a commercial. They're going to have one lower fee that gives you commercials, and then one the higher fee.
That's the suckification model. Yeah.
All right. So unsubscribe from Netflix. If everybody unsubscribed from Netflix, you know how fast their fee would come down? So my point is that the consumer has control over all of this. And, we just have to make the conscious decision that we want something better. And if you want something better and there's demand for it, guess what? Somebody's going to build it. And somebody would build a news service, as an example, that would be, a purveyor of truth, however you want to, motto it. But there just has to be the demand for it. And if that changes, and there's this new opportunity that exists, and people migrate towards that and leave these other kind of legacy media sources in the dust, they're going to change because they want to stay in business, right? And we, as consumers, we all forget that we have power to change everything. We have the power to do it. We just have to be willing to sacrifice, and that's the key word, right? You've got to give up something in order to make this change, but it'll get better if you do.
I so completely agree, and I got to move on to our last rant so we can wrap this up in time. But I totally agree, and again, that's sort of my whole point, which is we're seeing that happen in legacy media right now, as people are basically voting with their feet and with their dollars. And we saw it happen, and I'm not trying to get on whatever side of the issue. I'm just saying it was the consumer flexing their power. But we saw this with things like the reaction to Bud Light and to Target last year, right? Where the consumers basically said, I don't agree with this. I'm taking my money elsewhere, right? And to your point about social media, like we could, as a society, forget about the government for a second, just as parents say, you know what? We're just going to say no social media for our kids until they're a certain age, right? Now, it's super hard. I'm not saying it's easy. I'm not even saying that necessarily is going to happen anytime soon, but it's possible. And we do have that agency as a populace to say, look, we're going to support the change we want to see in the world. So anyways, totally agree with you. All right, getting to the second part of this rant. This isn't a rant, actually. This is actually a really funny story. But I'm wrapping it in the context of this is what government problem solving looks like. And Lance, you have ranted in the past that whenever government gets involved, whatever sector, whatever industry, it always makes things worse. right? We've seen that happen in education. We've seen that happen in housing. We've seen that happen in just example after example. So this is a great story. I just stumbled across this for the first time in forever, and I said I got to talk about this on the recap with Lance. Do you know who Dave Barry is?
Yeah, it's a guy that wrote Dilbert.
No, that's Scott Adams. Dave Barry is a humorist. He's
Yeah.
written columns for, I think, like the Miami Daily Herald for decades, but just super funny comedian, right? And I actually saw him present once, and he told this story, and it is 100% true. And you can find it online, and I will include a link to it in the description below this video. So this is how the government took care of a problem back in the 70s. So in 1970, in Florence, Oregon, a 45-foot, 8-ton sperm whale carcass washed ashore on the beach, okay? And I guess the beaches in Oregon are under the authority of the Highway Division, right? The Oregon Highway Division. So they had the responsibility of figuring out what to do with this massive rotting whale carcass, right? So they get a bunch of guys from the transportation division there, and they're looking around, and these guys are used to building highways, and so they're used to just kind of blowing things up that get in their way. So they decide, you know what? Let's get some dynamite. Let's blow this whale carcass into little pieces. And then all the beach scavengers, you know, the seagulls and the crabs that are nibbling on it right now, they'll have these small pieces and they'll be able to eat them a lot faster, and nature will take care of things. So these guys, you know, are trying to figure out how much dynamite to pack under this thing, and they keep packing and packing. And of course, the news crews have been following this now for days, and everybody's super excited. So the big day comes where they're going to blow up the whale. And so they get the media to move back, like, I don't know, a mile or so from the carcass. And everybody's watching, and they push the plunger, and boom, massive explosion, right? Whale just vaporized, basically. And everybody's looking, and they're like, all right, hey, you know, these guys did their job, you know, they blew up the whale, right? And then all of a sudden you start hearing the loud thumps of just massive chunks of blubber and whale parts descending all over the media and the crowd that's gathered. Like, they blew this thing so big that a mile away, there's just, you know, whale galore. It's falling on cars, it's staving in the cars. Actually, the guy who was in charge of determining how much dynamite to use, his car got destroyed. And he had just bought it at one of the local car dealerships that was offering a promo called "Get a Whale of a Deal" on a car because of the whole whale carcass thing. And you know, those little like scavengers that they were expecting were going to eat the whale, vaporized, right? They just blew every seagull and crab to kingdom come in like a half-mile radius of this whale. And of course, you know, basically they blew the center of the whale up. So there's still massive parts of the whale still there on the beach. So they didn't really even solve the core problem itself, but they just created this massive chaos and destruction, you know, in this radius around the whole whale. So basically, you know, that's just government, right? I mean, when it's got a solution, 9 times out of 10, that solution is just as bad, if not worse, than the problem it started out to solve.
Yeah, that's right. And I'm actually writing an article for next Friday because, you know, you and I have spent a lot of time talking about housing unaffordability. And so Elizabeth Warren and 3 Democrats now have a solution to make housing affordability better, which is to cut interest rates, which is exactly the opposite of what you want to do. So I've got a really good article on housing coming out next Friday that we can talk about.
Yeah, just classic. And who knows if that passes. If it does, we'll talk a lot about it here. I just want to share one of my favorite demotivational posters they have here for folks that are listening on the podcast. It says, "Government, if you think the problems we create are bad, just wait until you see our solutions." So anyways, guys, that Dave Barry story, way funnier if you hear Dave Barry describe it. I'm sure you can find a description where he's talking about it on the internet, but I will actually post the link to the actual news footage of the whale getting exploded, and then the huge chunks of whale carcass falling down on the audience in the description under this video. It's a 100% true story. All right, as we wrap up here, Lance, I did just want to give you a chance to say anything you like about any takeaways that you took away from the Houston event, like I said, I just had such a great time there in general. Still full from the meal you took me to afterwards. Still paying for that one. But all the folks that came up to me, so helpful, so generous, so wonderful to meet them all in the flesh. I hardly ever get out of my little man cave studio here, so it was such a great experience for me. And Greg Valier, is that how you say his last name?
Yeah.
Yeah, really smart guy. I'll probably have him on this program at some point in time to talk about the intersection of how politics impacts the economy. But what I took away from him was that government is basically the cluster show that we all suspect it to be, and that the real problem there, the root of the problem in all this, is money in politics. It's all the massive special interest money that has just basically infected its way into the political system. And I did get a depressing sense from him that's what drives the action there, and there doesn't seem to be any way to untangle that he can see easily.
Well, no, and I've talked about this before, which is, corporations, drive bills. They, the lobby groups drive political decisions, and government shouldn't be involved in politics. I mean, the corporations shouldn't be involved in politics at all, but they vote basically with their dollars, and they drive a lot of this. I mean, I'm still baffled how George Soros, who contributes to a lot of political outcomes in the United States, and he doesn't even live in the United States. So, we've got to figure out as citizens at some point that, if we want free, fair elections, we've got to and we want government to actually represent our needs and our goals and the things that we want, we've got to get corporations out of it. And, this is the part of the problem with the housing market, right? We have massive corporations involved in housing. That just makes things worse for everybody. So, yeah, it's unfortunate, but, there's not a way to correct that, because the people in charge of changing those bills are the ones that benefit from those corporations being involved through political campaigns, super PACs, et cetera. So they're certainly not going to vote for, getting rid of corporate money in politics, because that's what supports them. It's just like asking a congressman to vote for term limits. Why would I do that?
Right.
So these are the problems that we have with government. And our founding fathers never envisioned corporations being involved in the system. That's why it's not addressed in the Constitution. They would not be for this. This was exactly the stuff that goes on today is exactly the stuff that they were trying to leave and get rid of when they fled England and came here to establish a new country. And unfortunately, we're going right back to those very things that they were trying to get away from through a lot of the decisions that we make. It's unfortunate, but there's nothing that I can see on the horizon that'll change that.
That's interesting. Head corporations been around back in the 1700s. I wonder if it wouldn't just have been a separation of church and state, but it would have been a separation of church,
state, businesses,
business interests in state.
Yeah.
All right. Well, look, folks, I'm wrapping it up here. Lance, as usual, I'm going to give you the last word in just a minute here. But just want to give folks a peek on what's coming up this week in terms of interviews. We've got Sven Henrik tomorrow. We've got Axel Merck. Then we've got Michael Green, and then we've got Grant Williams. So it's actually a very strong week of great guests coming up here. Just want to remind folks that tickets are now on sale for the spring conference, for Thoughtful Money Spring Conference. Again, that's going to take place on Saturday, March 16th. Don't worry if you can't watch live. Everybody who registers will get sent replay videos within 24 hours of the event. And a reminder that right now it's on sale for the lowest ticket price, the early bird price. And I want to make sure everybody who wants to go gets the lowest price possible. So if you're interested in going, register soon. And a reminder, if you are a premium subscriber to our Substack, you'll get an additional 50% off the price. To become a premium subscriber to Substack, if you're not one already, just go to adamtaggart.substack.com. And as I said earlier, last week, I don't mind if you game the system, right? I don't mind if you sign up for 1 month for $15 to save the greater $50. Great. I want you to get the lower price. And then as a reminder for everything we talked about earlier about the importance of a good financial advisor, especially in this type of market environment, if you want to set up one of those free consultations, perhaps even with Lance and his firm, Real Investment Advisors, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple of seconds. All right, Lance, as usual, you get the last word, buddy.
Well, we'll just kind of see how this week goes, and next Friday we'll see what the market's doing. I have no idea, but we'll find out.
Appropriate for Groundhog Day. Hey, we'll just do it all over again next week.
Exactly.
All right. Well, Lance, thanks so much for getting in the saddle with me again this week. Everybody else, have a great weekend, and thanks so much for watching.